that student loans are a part of that financial aid package. So when institutions kind of say, hey, here's how much it's going to cost you out of pocket, um, they'll show you the grants and the merit scholarships and maybe any other federal or state aid that you might be receiving, but they typically include student loans as a part of that. So when you're looking at the out-of-pocket costs, you have to consider that part of your out-of-pocket costs will be having to repay loans once you've graduated from your degree or you've stopped attending college altogether. And a lot of families don't necessarily do that. They look at the financial aid package, they think it's so great, and then they realize that they have to borrow, or maybe they borrowed more than they initially thought they would. So really paying a close attention to those financial aid packages, reaching out to the financial aid office to ensure that your questions are being answered, and they're kind of walking you through what's being covered and what your actual out-of-pocket costs will be. Another important thing to review as a part of your kind of financial aid package is really the full cost of attending college. And attending college is more than just what you're billed for. It's more than just tuition and fees or room and board. There are a lot of expenses that are indirect expenses to a student. So the cost of textbooks, the cost of traveling if you're thinking about attending a college out of state, or somewhere that maybe you'll be commuting to, those types of things. Personal expenses, maybe you're deciding to not live in a residence hall, but you're going to be living in an off-campus apartment paying rent. Those are things that you can, and that the Department of Education will let you borrow to help pay some of those costs, and really making sure that you understand what those full costs are, and that you're just not borrowing um, unnecessarily to cover some of those expenses. So review the cost of attendance. And again, great questions to ask your financial aid office, your admissions counselor, even, if you're currently in high school, asking your high school guidance counselor about that process. That there's a lot of great resources to help you kind of evaluate that total cost of attending college. It's also critical that you complete and file your FAFSA application on time. And this presentation couldn't be any more timely given the fact that the 2021-2022 FAFSA became available on October 1st, so just a couple of days ago. Complete your FAFSA application on time, especially if you are a resident of Illinois attending a college or university within the state of Illinois, because of state funding that's available as a part of the Illinois MAP grant. The state has very different timelines to complete that FAFSA application. So we would hate for you to, if you did have eligibility and you missed certain deadlines, you would no longer receive that type of funding. And that's grant money. That's free money that's available to students through the state. So make sure you complete the FAFSA application on time. And sometimes there are schools and colleges that also have timelines for completing FAFSA applications, especially as it relates to some of the campus-based funding. So looking at the Supplemental Education Opportunity Grant, known as SEOG, which is a need-based grant. Federal work study sometimes is awarded based on the FAFSA being completed on time. So really kind of keep those things in mind. And if you haven't, I know it's only been released a couple of days, but if you can get to that sooner or later, sooner than later, really get that FAFSA completed for next year, just to get it out of the way. And it's something you don't have to think about, until next year. And then once the FAFSA is completed, make sure that you work with financial aid and complete any type of documentation that the school is requesting of you. So there are a couple of things that could come from the FAFSA application. One thing is known as federal verification, which basically, the Department of Education will randomly select certain files to be reviewed, verified, if you will. And they kind of make these, make the institutions, schools like Loyola, verify information that you put on the FAFSA application and ensure that it matches what you reported to the IRS. So schools may be requesting tax documents, W-2 forms, other types of tasks needed for you to complete the aid process. Make sure you get that documentation in on time, and work with financial aid so that we can update your awards accordingly and get aid paid to cover your tuition bills or to generate refunds. Those things are going to be critical and in covering expenses. And another piece to keep in mind too is I mentioned some dates with the FAFSA piece. There are dates even with verification and other financial aid tasks that if you don't get things completed, you may not be eligible for certain types of funding. I know the Department of Education releases data about this every year where families that are unable to or have not completed verification or have filed the FAFSA application on time leave hundreds of millions of dollars on the table nationally. And we want to make sure that as a financial aid administrator, make sure that every student is getting their maximum amount of eligibility and not leaving anything on the table, because ultimately that's going to reduce your indebtedness and kind of what the amount that you have to repay after college. So now we'll kind of get into federal versus private borrowing, kind of the differences between the two. And actually, I'll pause here just for a quick moment. I forgot to mention this at the beginning, but if you're not familiar with Zoom, there is a chat feature at the bottom. If you have a question, feel free to type your question in the chat. You can send it to me directly. And at the end of the presentation, I'll stop sharing my screen to look at those questions, but feel free to ask those throughout the presentation, and we'll go back and address any questions that you have at the end. I apologize for not mentioning that sooner. So if you're an undergraduate student, from a loan perspective, and these are dependent on your FAFSA eligibility, there are two types of loans for you as an undergraduate student. You have a federal subsidized Stafford loan and a federal unsubsidized Stafford loan. The biggest difference between the two is that one you pay interest on while you're in school and during your grace period after graduation, and the other accrues interest right away. So the subsidized loan, that's the loan. It's 0% interest while the student is enrolled, and remains 0% interest during that 6-month deferment after graduation. The unsubsidized loan is the loan that will accrue interest once it's dispersed to the school. So you will start accruing interest on that right away. So as you're looking at borrowing, we really encourage families to start with the subsidized loan first, because that's going to be in your best interest as a student. And then if you need additional funding to help you, consider doing the unsubsidized Stafford loan. And there's some other information on here. I'm not going to go, column by column, but you can see kind of the amounts that are available depending on your grade level and dependency status, the current interest rates. One thing to also keep in mind is that as well-intentioned as student loans are, federal student loans are, Uncle Sam does like to take a little piece of the pie. So if you borrow, let's say, $3,500 in a subsidized Stafford loan as a first-year student, the Department of Education will take an origination fee or a processing fee. So what is actually paid to the school is a little bit less than what you actually have to repay. You're going to be responsible for paying back the full $3,500 to the government, but the school is only going to be getting, a little bit less. That after that origination fee, probably about pretty close to 3,500, but 98% will come to the school, and that little bit, as you can see, goes to Uncle Sam. So keep that in mind as you borrow, is that there are those origination fees for any federal loan that you borrow. If you are considering graduate school, you'll notice right away that the subsidized Stafford loan goes away. So there is no subsidy for graduate students. There used to be many, many years ago, but that was, as a part of budget reductions and things within, Congress, and looking at um, kind of national debt. They realized that it was kind of too expensive, and they wanted to kind of cash in on graduate students, unfortunately. So they got rid of the subsidy and only offered the unsubsidized Stafford loan for graduate students. But you can see the amount is significantly more than if you were an undergraduate student. So you can receive up to 20,500 as a graduate student to help with your studies, pay tuition, pay for those indirect expenses that I had mentioned before. But again, the interest rates, the origination fee, that processing fee is still there. And this is the loan that accrues interest. So you're not getting that 0% while you're in school, or that 6 months after graduation period. That interest accrues on the loan right away as a graduate student. So as you're looking at and working with your financial aid office, with your admissions office, kind of talking about the gap that you still have to pay out of pocket, this is where the federal versus private loan piece really comes into play. So there are really two types of additional, from a borrowing perspective, two options that students and parents can consider to help cover their remaining expenses. The first is federal. It's known as a federal plus loan, and this is also applicable to a graduate student. So there's a federal parent plus loan and a federal graduate plus loan. And you can see, and again, I'm not going to go through each one of these, columns here, but, it's the plus loans, because they're federal. They are through the U.S. Department of Education. Parents, this allows you to borrow on behalf of the student. So this is a loan that would be in your name. And by student, I mean dependent student, and undergraduate student that is dependent. So parents can apply for a plus loan. There is a credit process. So the Department of Education, they do a credit check to make sure that, you're not in default on any loans, or there haven't been any kind of bankruptcies, kind of some of those big default items on your credit report. But typically parents can get approved for a federal plus loan. If you're a student attending graduate school, that's where the graduate plus loan would come into play. Again, there is that credit check, but it's looking at those big consumer red flags, right? Default, bankruptcies, those types of things. These are loans that you can borrow up to the full cost of attendance. So as I mentioned at the very beginning, you have your direct expenses and you have your indirect expenses. So your direct expenses are things that are billed by the university, typically tuition and fees, room and board. And then those indirect expenses is everything else. So things that you would pay out of pocket, like books and travel and personal. You can take these loans to borrow up to that full cost of attendance. With private or alternative loans, typically it's just the student. It's a loan in the student's name. If your student is an undergraduate, not many 16, 17, 18-year-olds, 16-year-olds probably too young to be graduating unless they're really smart. But, the 17, 18, 19-year-old student typically doesn't have established credit history. So I see it probably 98% of the time they would need a parent as a co-signer for any type of alternative or a private loan. These vary by lender. So these are not federal loans. There's participating lenders that offer these educational loans for students. Again, it can go up to full cost of attendance. We've kind of seen a shift a little bit. So, the plus loan, and this is really where kind of some education and working with your financial aid office really comes into play, is as you get into some of the interest rate pieces. Because if you have really great credit and you are approved for a private loan, you could get a lower interest rate from a private loan than you would in a parent plus loan. or if you're a graduate student and have, great credit as a graduate student, you may want to consider a private loan, just looking at the interest rates in itself. And then there are a lot of lenders that don't charge that origination or that processing fee. So what you borrow is what the school gets. There's no confusion about, well, I took, a $15,000 loan, but the school only, received 14,000 because of the origination fees. You remember, you're still responsible with any federal loan to pay that gross amount that you borrowed, not the net amount after those origination fees. And then just kind of some more information to consider: federal versus private. Make sure that as you're evaluating private lenders, looking at the repayment requirements, because they could be very different. Credit is a big process. And the federal side, it says you don't need credit, and that is true for student loans, for the federal Stafford loans, but it is true for plus loans. So any federal plus loan, graduate or parent plus loan, that does require a credit check, along with private loans. And then interest rates, I just touched on, they can be very different. Sometimes you can get a much lower interest rate if you've got good credit, or if you don't, you could end up with a significantly higher interest rate than you would with the federal loan. And then a really good thing to remember is at the end of the process is that loan forgiveness piece. So, and we'll talk about this kind of towards the end, but with federal loans, you may be eligible for that loan forgiveness if you're working in a public service field. Whereas with most private lenders, they typically don't offer that. There may be some form of loan forgiveness given, with circumstances, but I have not really witnessed that in my 15 years of being at Loyola. So the odds are pretty slim. So that's a very big thing to consider, not just what you're borrowing at the beginning, but also how you're going to be repaying that at the end is critical to kind of the whole process. So these are really important things to help reduce borrowing. So if you're an undergraduate student or even graduate student, um, talk with financial aid about federal work study. Anything you can do to work on campus with an on-campus job, or even through community service work, which is offered by schools, to do work within your community, to get paid for that, and to use that either to pay your tuition bill, or to use that to pay for your indirect expenses, like, your utilities, or, rent, or those types of things, just so you don't, to limit your borrowing. Work study is a really great option. I will note that with work study, you will see it as a part of your financial aid award. At some institutions, not all, will have work study listed. It is not an amount that pays towards your balance automatically. They typically just make you aware that you're eligible, and then you would have to find a job, and then you would earn money in a form of a paycheck, and that's reduced from your work study allowance that you have. If you don't use it, it doesn't hurt you in any way. The school isn't going to come back to you and say, well, we gave you 2,000, we awarded you rather 2,000 in work study. You didn't use it, so now you owe us an additional 2,000. That's not how that works. So there are a lot of students that don't utilize work study, and that's totally fine. So just kind of keep that in mind too. I would also highly consider you to evaluate payment plans. So connect with the student business office or the bursar's office about ways to pay your tuition. If you can set up a payment plan to pay a portion of your tuition bill out of pocket to reduce borrowing, do it. Anything that you can do to reduce borrowing is going to be in your best interest. We have families at Loyola that will have their students set up a payment plan for 50, 75 bucks a month, and the student will get an on-campus job, and the parents will make them pay that much towards their tuition. I know it doesn't seem like a lot, but I think it just kind of has the student have some skin in the game, if you will, maybe in addition to some student loans. But at the end of the day, it will ultimately reduce your borrowing. It's going to reduce the interest that you're accruing, so that you're not graduating with unnecessary loan debt. Kind of a default response from any financial aid office that you reach out to when you get that award letter and you're looking at your out-of-pocket costs, and you say, hey, is there anything else, that you could do for my son and daughter, for my student? Our response is going to be to look at outside scholarship resources. And it's very true. I think what's critical about this is that hopefully the schools that you're looking into, or maybe even your high schools, will point you to very direct scholarship resources, not just a kind of a general website. Talk to your school about that, because schools do a lot of vetting of those websites or scholarship search engines, or they might even have their own. So really connect with the financial aid office to inquire about outside scholarship resources to help reduce that borrowing as well. And then just general financial wellness programs. I know these things are kind of offered maybe in high school, but anything for you to be kind of a more well-rounded student, after graduation is just going to be a benefit to you. So really check to see that, if the schools you're interested in have those financial wellness programs, how you can get involved. I know there's a number of schools that, that do offer, and Loyola Chicago does this, where there are, we do kind of monthly scholarship contests and things where, it can be as simple as posting a picture on Instagram, or attending like what would have been face-to-face program events, but right, like a virtual event, and you would be automatically registered for a financial wellness scholarship. So those things are out there, they exist, they just take a little bit of looking into. So I would encourage you to look at those financial wellness programs within the financial aid office or within the dean of students office, just to see what the school does in support of developing a well-rounded kind of, and a holistic approach to their students, and supporting them from, undergraduate even to graduate in life outside of school. So now we're kind of getting into kind of the end of the loan piece. So we kind of talked about things to consider at the beginning, the difference between federal and private, um, things to consider to reduce borrowing. This is really more if you are currently in repayment of loans. Hopefully you're aware that some of these laws have been put into place, or executive order by the president have been put into play in support of students. So it started way back in March, at the very early onset of COVID, where interest rates were dropped to zero for a period of 60 days. They suspended payments. If you were in default of loans, they would stop collections. So that went on for about 60 days. And then they realized it wasn't going to be long enough. So when the CARES Act was signed into law, it extended that relief into September. And then in early August, executive order was used to extend those student loan relief through the end of this year, December 31st. So if you are currently repaying on any student loans, either as a student or a parent, you're not, or there's no interest accruing, you're not required to make payments. I would highly encourage you to make payment, because any payment that you're making now through the end of December is going right to the principal of the loan. There's no additional interest accruing. It's in your best interest to do that. But I just wanted to point this out because this is kind of developing. I don't know what the status is going to be on possibly extending this even further. I've kind of heard just kind of before the presentation started that the president had kind of put a pause on negotiations for another kind of a stimulus plan, and kind of some of this student loan piece was being considered as a part of that stimulus plan. And so I don't know what's going to happen, but hopefully, something will be extended for borrowers beyond December 31st, because the reality is that, there are a lot of families and students that are really have been financially impacted by COVID. So I really hope to see this extended for a little bit longer. So now we're going to get into the good stuff, loan repayment options. So this is once you're done with school and you never want to borrow another student loan again, but you're to the unfortunate part of having to repay. So there are basically three loan repayment options. There's a standard, an extended, and an income driven. And then there's little plans within the larger overarching plans. As you can see, there's level versus graduated for the standard and extended, and then there are 4 different payment plans within the income driven plan. So we'll kind of talk about each one of those individually. The first being a standard repayment plan, and it is what it says. It's a standard. It's a standard plan. It's 10 years. Generally speaking, it's a flat amount that you pay every single month for 10 years. It's basically taking the total amount that you owe, dividing it by 10 years. There's your monthly payment, and you just make your payment for 10 years, and then you're done. And you can see kind of the fixed line. Where it's, that's kind of the standard where you just start from the beginning, your payments are the same for 10 years. And, after the 10-year period, you're student debt free. There's also the graduated, which basically means you start with lower monthly payments at the beginning, and then those payments get larger within that 10-year within that 10-year repayment period. Typically, the graduated plan will increase every 2 years. It's a great option if you are maybe recently graduated and don't have a job yet, but can start making payments. This would be a great option, knowing that maybe you'll be employed soon, or maybe you're kind of in between jobs or something. So, I mean, it's kind of a good thing to consider. If you're kind of experiencing maybe some inconsistent payment income, that if you will. So that's the standard. And then the extended, it's basically the standard plan, except it extends from 10 years to 25 years. So you have your fixed plan where it's equal payments for up to 25 years, or you can do your extended graduated, where you start with lower payments and then they get larger over the repayment period. Again, that graduated, it increases typically every 2 years. You see the increase in that. The downside to any type of extended repayment plan is that you're paying much more because of all the accrued interest. Going from 10 years to 25 years, you're just paying a lot more on a loan than you would if you could just pay it in 10 years. So I don't know, of too many families that take advantage of this plan in particular, but it is an option if if you kind of need that longer time frame, because maybe what you've borrowed is significant. You can't take 50, 60,000 or maybe anything over 30,000 over 10 years, but you could do something over 20, 25 years. This would be a really good option, especially for the higher loan balances. Income-driven repayment plan. So again, it is what the title speaks for itself. This type of payment plan is based on the income that you've earned. You can see there are 3 different years. There's a 10-year, 20-year, 25-year. Typically, it's over a 20 to 25-year period. But it's based on income. Every year, you would need to provide some type of income information to the Department of Education, typically a tax return, to remain in the income-driven repayment plan. You would have to do that. But you can see, maybe you have a first job and you're doing great, and then you lose that job. Well, you can have an adjustment to your income plan because your income's reduced. But then maybe you get a new job, and so your payments are even more than when you had your first job. So that's great. And then you get a promotion, so then you can pay a little bit more. So there's way more flexibility in that income-driven repayment plan. But again, keep in mind that the longer you spread those payments out, the more you're going to be paying in interest over the course of time. But it's a really great option to consider if you maybe don't have consistent income, or think that maybe you'll be working part-time and going to school, or there's all sorts of things that you need to consider with the income driven repayment plan. And then, as I had mentioned before, within the income driven repayment plan, there's basically 4 subplans. Basically, they all have to do with how your payments are capped. So the revised pay as you earn, your payments are capped at 10% of your discretionary income. And then you can see that the Department of Education uses, AGI minus 150% of the state poverty guideline for your family. So there's they have a methodology in how they determine that. And then the remaining 3, again, are based on that discretionary income, but it varies at 10%, 15%, or 20%. So these are really important for the low income students who are doing work. Maybe they're doing work that's not nonprofit, but they're doing work that just doesn't pay well. There are things that these income driven repayment plans become really beneficial to that group of students. So really take your time. And again, financial aid offices, even if you're a recent graduate or if you've been gone for several years, reach out to your former institution, the financial aid office, and they'll help walk you through that process, make sure that you're understanding all of these different options, answering your questions. They will help you navigate that. The Department of Education, they really do a great job at helping students and families as well through this, because you can't change. You can't swap from one repayment plan to another. Once you pick one, that's it. There's no kind of jumping, back and forth in between all of these different repayment plans. So that's why do your research, do what's best for you in kind of your long term, within the 10 to 25 year window, if that's kind of what you need to repay, but really kind of do your research on that piece. We get asked a lot about consolidation versus refinancing. So consolidation, and this was much more applicable many years ago when your lender changed. So back in the day, you could have a loan with, maybe when you graduated, you could have loans with maybe 3, 4, 5 different lenders that were kind of the guarantor of the loan, the processor of the loan. That basically went away when the Department of Education kind of got rid of the middleman and decided to do direct lending from the Department of Education directly to the school. But consolidation is still incredibly important because your interest rate on those loans is going to change every year. So if you can consolidate your federal loans, and again, consolidation is only available for federal loans. If you consolidate your loans, it's one payment with one interest rate, and that's what you're doing. It's taking all of those federal loans and putting them into one. Refinancing is really kind of it's a private lender or a private company that underwrites a new loan. So they basically will pay off all of your loans with the Department of Education and replace it with a loan and a new interest rate with them. That is available for federal and private loans. It's really great if you have good credit, stable income, because that improves your profile, and you could end up with a lower interest rate than doing kind of a weighted average with consolidation. It kind of takes all of the different interest rates you have and does a weighted average, and then that's what you have for the remainder of the consolidation period. And so refinances is more private, practice. Consolidation is done with typically with the Department of Education. You can consolidate with other lenders as well. There are guarantors with the, that work with the Department of Education that do consolidation. So it doesn't necessarily have to be, through the Department of Ed specifically, but they do have partners that will help you with those processes. So that's the big difference between the consolidation and refinancing piece. It's really looking at what type of debt you have. If you have both federal, because you have student loans, and maybe you have a private loan, you might want to do refinancing to kind of group all of those together. If everything you have is just federal, you might want to consider consolidation. But then again, interest rates could be a big part of that decision-making process as well. And lastly, we'll talk about public service loan forgiveness. So this is really, applicable to anybody that has earned, or basically has received a loan after October 1st of 2007. You have to make, 120 qualifying payments in an income-driven repayment plan, or one of those. I'm sorry, yes, in the income-driven repayment plan, and you have to make 120 qualifying payments. So you have to make all of those payments consecutively. You can't just make, a lump sum payment and then expect to be in, to be considered for loan forgiveness. You have to make every month 120 payments, and then really you're having to verify with the Department of Education where you're employed. So it could be a government agency, AmeriCorps. There are a lot of not-for-profit organizations. Really any non-for-profit that is tax exempt under Section 501c3. That's really critical, because there are a number of not-for-profit organizations that do not have that tax exemption, and therefore you would not be eligible for public service loan forgiveness. So it's really important, if you're thinking about going into a private sector, kind of local organization work, that employer does have that Section 501c3, and they filed that every year with the IRS. And then it's also really important to know that that nonprofit has to have a purpose to provide certain types of public service. So again, law enforcement will never be tax exempt under Section 501. Our good friends at Skokie Library would qualify because of the work that they do for for Skokie, and just kind of in the things that they do for the community. So library service would be a great example. Law enforcement, police, firefighters, all those kind of people would qualify for this public service. And then obviously you've had to have borrowed direct loans. So that's kind of what would be forgiven, would be those direct Stafford loans, or potentially a Graduate Plus loan. Perkins and FFEL, those are old. Perkins doesn't exist anymore, unfortunately. And then FFEL is an old, that's kind of what I was referencing before about having different lenders. That's kind of an old piece. So if you're interested in public service loan forgiveness, you can go to studentaid.gov. They have a help tool to help you navigate that piece. You have to submit that employment certification form for that you complete and your employer completes or would sign off on. And then, you can kind of read, read the rest. What's really important is the last bullet point at the bottom, is that, how I had mentioned previously or above, you're making those 120 qualifying payments. After that 120th payment, don't stop making payments. You must continue to make payments while you're going through this application process and waiting for a decision. If you stop making payments, the Department of Education will see that, and you will not qualify for loan forgiveness. So please continue to make your payments even after that 120, until you've got that official notification that you're a part of that loan forgiveness process. And these are just some great resources for you to consider. So some federal aid websites. NSLDS is a great website if you wanted to learn more about your borrowing history. So if you're a recent graduate or trying to figure out how to repay your loans or what you've borrowed, certainly reach out to the financial aid office at your institution. But NSLDS it's all there from any school that you've attended. If it was a 2-year, 4-year master's program, it will all be listed in NSLDS. So you can, and that's incredibly important to make sure that they're not trying to say that you borrowed something that you didn't. So really keep an eye on that. And then our good friends within the state of Illinois, ISAC, have great resources, especially for our undocumented or non-FAFSA filers that are not eligible to complete that federal application. With ISAC's help, the state has new programs and something called an alternative application to be considered for state funding, that Illinois MAP grant that I had mentioned. So it's a great resource. Utilize that. ISAC is a great friend of financial aid, a great supporter of our high school seniors, and doing all sorts of amazing things. So if you can connect with them, they have great resources and tools for you to consider. So that concludes my presentation. And so I'm going to stop sharing my screen and see if there are some questions that have come through, and there have been a few. So there's been a question for the subsidized federal loan repayment. Is it possible to start paying them off early before they graduate and then reduce the amount of interest you have to pay? That is a fantastic question. And the answer is yes. You can start repaying your student loans at any time. So if you have a student that's in school now, or even during that 6-month deferment process after graduation, you can start paying those off because all of that is going to the principal of the loan for the Stafford subsidized loan. And most of it would go towards the principal, or maybe even some interest with the unsubsidized, but it will absolutely reduce the amount of interest you have to pay once you actually start doing that. So any amount you're able to do, there's no prepayment penalty or early payment penalty, nothing like that. So please keep doing that. That's a great question. There is a question kind of about education savings account. So there are programs within the state of Illinois if you have younger kids. So I have 2 kids I have 2 in 8th grade that attend Fairview South in Skokie, that my wife and I were actually having this conversation about, being more proactive in saving for their college. So there are certain types of educational savings accounts that you can use. Most people start those when kids are very, very young. Let's see, the question is, whereas parents, so if, sometimes there's grandparents or there's family members that have created these types of savings accounts on behalf of a family member, that is completely acceptable. That does not hinder in any way a student's ability of getting access to loans at all. So that is fantastic that if you're able to do that on behalf of a family member, I think that's great. If information you should provide to parents, you really don't have to do anything with those savings accounts really until your student has decided which school they're attending, because at that point sometimes the savings account may require like a statement from the bursar's office or the student account office, or sometimes the school will do direct billing to those educational savings accounts, those 529 plans, if you will. So it kind of depends on how you have that set up, but I would wait at least until your student has selected his school, is admitted, all of those great things. So you have some some time. There's questions about, just kind of receiving maybe some inheritance from, family members, and kind of how that could, impact those types of things. Again, doesn't necessarily impact the student if you're willing and able to help them through school using those resources to reduce indebtedness. That's great. There are some, um, there are some families that want students to borrow just a little bit so they have some skin in the game, but that's a personal decision that the family has to make. Um, but there's a question about resources about how to educate yourself about student loans. That resource page that I had shared, and I will be sharing this presentation with the Skokie Library team. So feel free to reach out to them, and they'll be able to share my presentation with you. That will have all of the resources page. Would be great for you to kind of educate on yourself on student loans and kind of things to consider. Um, and again, student loan, that process isn't going to start until he's you know selected that the school. Maybe it's Loyola Chicago, maybe he'll stay in Chicago, maybe he'll become a future Rambler, but it wouldn't happen until he's admitted, and then you're kind of going through that financial aid process with that particular school. So you do have some time to do that. And he would still qualify for loans even if you're able to help support him with some of the balance. So there's a great question about the public service loan forgiveness. So the 120 payments means that they've been paying for 10 years and then would be eligible. That's a great question. And I apologize, I should have been a little bit more clear. So that's part of the loan forgiveness process. So your loans won't be forgiven until after those 120 payments are made. So you are applying for, you're going to be in the income-driven repayment plan. You're going to make your payments for 120 months or 120 consecutive payments. And then at the end of that 10 years, then you will apply for public loan forgiveness. So I apologize that there was some, I don't think I made that very clear in what I was saying before. So there are kind of two things. So it's not like you pay for 10 years and then you would be eligible for loan forgiveness. So they're kind of part of the same process. So I hope that answers your question. There's a question: do private universities look at a student's financial ability for their acceptance? No. So most schools are what we call need blind. So the admission to a school, and I'll use Loyola as an example. Your student's admission into Loyola Chicago is based on his academic profile. It is not based on information that may come from the FAFSA application. Because there are some families that do file early, and there are some families that file that a little bit later in the cycle. It is not based on that at all. So that's an excellent question. Most schools are need blind. How are those savings, the 529s, factored into the financial aid equation when determining a financial aid package? So that's a great question. If you have one of those 529 plans that we've kind of talked about a little bit, when you complete the FAFSA application, that will be something that should be entered as a part of that FAFSA application as potential income that could be used to pay for your students' education. It should be listed. That's what I'll say, is that you should be listing those 529 plans as a part of the ability to make payments towards your students' college tuition. The Department of Education will want to know that. I don't think there are any other questions at this point. So once again, I will share this presentation with the Skokie Library team. So you can have that and kind of go back through that at your own pace. Thank you very much for your time this evening. I really appreciate it. If you have questions, hopefully, you feel free to reach out to me. I'm at Loyola Chicago. You can search me in our directory. Happy to answer questions, even if you're not, a current student or an alum or anything. You just have general questions. It's always great to connect with members of the community. So thank you, everybody. Thank you for your time. Enjoy your evening, and we'll see you all soon.